Today, we're really zeroing in on the essentials of smart investing. Our goal is to give you, the person building that solid financial base, the core wisdom you actually need.
That's right, we're moving past the noise, the jargon.
Exactly. And focusing on the timeless insights from, well, a true legend in the field.
And that legend is Benjamin Graham. We're using his landmark book, The Intelligent Investor, as our guide today. This book didn't just offer tips, it fundamentally changed money management.
Shifted it from guesswork to something analytical.
Precisely, into a real profession. It gives individual investors like you that crucial framework, both analytical and, maybe just as importantly, emotional.
And Jason Zweig's commentary in the later editions really drives home how Graham's ideas hold up, doesn't it? Through all sorts of market ups and downs.
It absolutely does. It shows the enduring relevance.
So our mission today is pretty straightforward. Arm you with that foundational knowledge, help you build a rational long-term view, stay disciplined, and crucially, avoid those common investing mistakes.
Okay, so let's start with Graham himself. Why is he considered such a giant? He's often called the greatest practical investment thinker of all time.
That's quite a title.
It is. And Zweig points out that before Graham, investing often felt more like, well, superstition or guesswork. Graham's earlier book, Security Analysis, really laid the groundwork for a modern analytical profession.
And The Intelligent Investor made those complex ideas accessible, right, for the everyday person.
Exactly. Zweig even calls it the best book on investing ever written for individuals. It's not just about the numbers, it's heavily focused on managing your emotions, which, let's face it, can be the biggest challenge.
Definitely.
There's a great anecdote Zweig shares. He read the book in 1987, just before the crash. He was struck by Graham's certainty that bull markets always end.
And then, boom, October 1987 happens.
Right, the biggest one-day crash in U.S. history. It really validated Graham's perspective in a dramatic way.
Makes you think about the dot-com bubble, too. Graham wouldn't have been shocked by that either, would he?
Not at all, according to Zweig. Graham had his own early, painful experience with hype. A company called Savold Tire back in 1919.
What happened there?
Big initial gains, lots of excitement. Then it turned out to be fraudulent. Stock went to zero. A harsh lesson, but probably one that shaped his entire philosophy.
Probably led to his meticulous research style. He was known for digging deep, wasn't he?
Absolutely. He wouldn't just glance at reports. The Northern Pipeline story from 1925 is a perfect example. He pored over these obscure filings.
And found something others missed.
He realized the company held bonds worth far more than its stock price suggested, so he bought the stock, pushed management for higher dividends based on those assets, and made a significant profit. It really highlights his focus on intrinsic value.
Okay, let's unpack that intrinsic value and some of his other core ideas. What did Graham mean when he said a stock represents ownership?
He really wanted people to shift their thinking. A stock isn't just, a flickering price on a screen.
Or a ticker symbol?
Right. It's a genuine piece of a real operating business. And that business has an underlying or intrinsic value separate from its day-to-day market price.
That's a fundamental shift. It helps you see past the daily noise, which connects to his famous Mr. Market idea, right?
Exactly, Mr. Market. He imagined the market as this rather manic, depressive business partner.
Okay.
Every day, Mr. Market shows up offering to buy your share of the business or sell you his, but his mood swings wildly.
So sometimes he's overly optimistic, asks for a crazy high price.
Precisely. Overpriced stocks. And other times, he's deeply pessimistic, offering to sell you shares for way less than they're worth.
Creating bargains.
That's the key. The intelligent investor doesn't get caught up in Mr. Market's moods. You use his pessimism to buy cheap and his excessive optimism to sell. Market swings become your opportunity, not your enemy.
Take advantage of the overreactions. And this ties into the price you pay affecting your returns.
Directly. Graham stressed this inverse relationship. The higher the price you pay for something, generally, the lower your future return is likely to be.
Seems simple, but easy to forget when everyone's excited.
Very easy. And even with the best analysis, Graham knew you couldn't eliminate one key risk.
Which is?
The risk of just being plain wrong. Your analysis could be flawed, or something unexpected could happen to the business.
Right. Life happens.
Which is why he championed his most crucial principle, the margin of safety.
Okay, the margin of safety. What does that mean in practical terms? How do you achieve it?
At its heart, it means you never overpay. No matter how great an investment looks, you buy only when there's a significant discount between the price and your estimate of its intrinsic value.
So you build in a buffer.
Exactly. A cushion. It protects you if your value estimate is a bit off or if things don't go as planned. It minimizes the odds of a big loss. It's about caution.
And beyond the analysis and the margin of safety, Graham said success also comes down to something internal.
Yes, absolutely. He believed the real secret to your financial success is inside yourself. It's about critical thinking, not just blindly following Wall Street.
And having the right mindset.
Patience, conviction, discipline, courage. These are vital. You need them to resist those emotional market swings Mr. Market throws at you. Graham famously said, your behavior as an investor is more important than the behavior of your investments.
That's powerful. How you act matters more than how the market acts. Okay, let's shift gears slightly. The book was updated and includes perspectives from around 1971. What changes was Graham seeing then?
Well, by the early 70s, he noticed this big trend towards performance investing in funds, a real focus on short-term gains.
Which he wasn't keen on.
He found it disquieting. He felt the core principles hadn't changed, but how you applied them needed to adapt to the financial climate.
And the climate in 71 was a bit shaky, wasn't it? The market had recovered but was dipping again.
Exactly. But his basic philosophy held firm. A key observation he made then was about bonds versus stocks. Bond yields had become quite attractive.
More attractive than stocks, potentially.
In late 71, yeah. High-grade utility bonds were yielding around 7.3%. He figured stocks might return maybe 7.5% before tax. Bonds offered similar income, but with much better protection for your principal and interest payments.
So less risk for a comparable or even better potential return at that specific moment.
Precisely. It led him to conclude that for the defensive investor at that time, bonds actually looked like the clearly preferable choice. He even suggested maybe going 100% bonds if that yield gap persisted.
Wow. That really shows his adaptability, focusing on the current facts. Now, he also made this distinction between two types of investors: defensive and enterprising. Can you break that down?
Sure. It really comes down to your goals and how much effort you're willing to put in. The defensive investor, their main goal is safety, freedom from worry. They want decent results with minimal fuss.
Sort of a set-it-and-forget-it approach.
Largely, yes. Whereas the enterprising investor, they're aiming higher. They want better than average returns and are prepared to do the extra work, the research, the analysis to potentially get there.
So for the defensive investor, wanting that simpler path, what did Graham recommend regarding stocks?
He suggested sticking mainly to large, established, financially sound companies. Think the components of the Dow Jones average back then. He was pretty clear that a defensive investor probably wasn't going to beat the market picking individual stocks.
Okay.
He did suggest a strategy where they could adjust their stock allocations, say, between 25% and 75% based on market levels. Buy more stocks when the market's down, sell some when it seems dangerously high, a counter-cyclical approach.
And the enterprising investor, the one willing to do more homework. What opportunities might they look for?
They might dig deeper to find undervalued stocks that the market is overlooking. Or look into what Graham called special situations, things like mergers, liquidations, reorganizations. Historically, these offered potential for good returns if you knew what you were doing.
But still risky.
Oh, absolutely. Graham warned that even with skill and effort, enterprising investors could still lose money if they focused on the wrong things. And he noted that even back then, areas like mergers were getting more competitive, making those special situation profits harder to come by.
So thorough research and understanding risk were key for both types. Now, Graham was very critical of confusing investing with speculating. What was the danger there?
He saw it as a fundamental mistake. Speculation is focused purely on price changes, often short-term, without regard for the underlying business value. He saw how people got swept up in booms like the 90s tech bubble.
Thinking, if it works, it must be right.
Exactly. Ignoring risk, ignoring sustainability, just chasing quick profits.
He wasn't a fan of things like day trading then.
Definitely not for the average investor. He criticized chasing hot trends, abandoning diversification, following simplistic formulas. He felt these relied on luck, not business fundamentals.
Like the foolish four strategy he mentioned.
Right. That was a popular mechanical strategy for a while, but it didn't hold up long term. His core message was always, a stock's future depends on the business's future. Simple as that.
Substance over sizzle. Another factor he highlighted was inflation. Why was that so important?
Because it's insidious.
Yeah.
It quietly erodes your wealth, your purchasing power, without the drama of a market crash.
So a 5% gain isn't really a 5% gain if inflation is 3%.
Exactly. Your real gain is only 2%. Graham stressed you have to measure your investment success after accounting for inflation. He reminded people of high inflation periods, showing how much value could be lost. Don't get complacent about it.
A crucial reminder. Now, around early 72, when he was finalizing the edition, did he comment on whether the market seemed too high then?
He did. He mentioned that in previous editions, he'd always tackled that question, is the market too high for conservative buying now? But he also admitted how incredibly difficult it is to make that call accurately, even with lots of historical data.
Humbling, even for Graham. So his focus remained on strategy, not market timing. Which brings us to his portfolio policy for the defensive investor around that time. What was the basic structure?
The core was simple. Divide your money between high-grade bonds and high-grade common stocks.
And the split.
He recommended a flexible range, never less than 25% in stocks, never more than 75%. And the rest in bonds. A 50-50 split was his suggested default or starting point.
And the flexibility of that 25 to 75 range was for being opportunistic.
Yes, exactly. The idea was to lean into market swings. When the market tanks and stocks are cheap, you'd gradually increase your stock allocation towards that 75% mark. When the market seems dangerously high, you'd reduce stocks maybe down towards 25% and build up your bond position.
Buy low, sell high, but in a disciplined, gradual way. What did he say not to do?
Crucially, don't borrow money to invest that's adding leverage and risk you don't need. And definitely don't increase your stock percentage just because the market is already high. If you need to reduce stocks, sell them and put the money into good bonds or just hold cash.
What about dollar cost averaging, investing fixed amounts regularly?
If you were already doing it consistently, he said you could continue or pause if you felt the market was truly excessive. But he strongly advised against starting a new dollar cost averaging plan when the market seemed very high because the initial losses could easily discourage people from sticking with it.
Discipline again? Stick to the plan. Okay, let's look at the bond side of that 1972 portfolio. What kind of bonds did he favor for the defensive investor?
Safety first. So U.S. government bonds were top of the list, backed by the full faith and credit of the U.S. He mentioned savings bonds and other government issues.
What about corporate bonds or others?
He was cautious. Lower quality or second-grade bonds, only if you could get them at a real bargain price, otherwise the risk wasn't worth it. He pointed to losses in railroad bonds in the past as an example. He also mentioned preferred stocks, but noted they were generally better suited for corporations because of tax advantages, not so much for individual investors.
So for individuals back then, high-quality government bonds were the main focus for the safer part of the portfolio. This leads to a key question for everyone. How do you set your own stock bond mix? What was Graham's guidance?
It really boils down to your personal comfort level with your risk tolerance. If you can handle more volatility, maybe you're closer to that 75% stock, 25% bond allocation. If you're very risk-averse, prioritize safety, you might lean towards 75% bonds, 25% stocks.
And once you set that target allocation, should you change it often?
This is critical. No, don't change your target based on what the market is doing day to day or month to month. Only adjust it if your life circumstances change significantly. Income, retirement timeline, major goals.
You need to rebalance periodically.
Yes, maybe every 6 months or once a year. If stocks have soared and now make up too much of your portfolio relative to your target, sell some and buy bonds to get back in balance, or vice versa. It enforces discipline, buy low, sell high, systematically.
Keeps you on track and stops emotions taking over. Okay, fast forward to today. Bond investing has more options now. What are the key choices?
You've got taxable versus tax-free bonds, short-term versus long-term maturities, and the choice between buying individual bonds or using bond funds.
Taxable versus tax-free, when does that matter most?
Generally, if you're in a higher tax bracket, holding tax-free municipal bonds outside of your retirement accounts like IRAs or 401k makes sense. Inside those tax-sheltered accounts, taxable bonds are usually fine, as the interest isn't taxed annually anyway.
And individual bonds versus funds.
For most people, bond funds are simpler and provide much better diversification unless you have a very large amount to invest. They're convenient, you get regular income, easy reinvestment. Exceptions might be ultra-safe U.S. Treasuries or maybe specific munis if you have complex tax needs.
Makes sense. Let's swing back to stocks for the defensive investor. Graham mentioned growth stocks. How did he view those?
He defined them as companies with strong past growth expected to continue. He saw the appeal, obviously. But the problem was usually the price. Growth stocks often trade at very high valuations, baking in a lot of optimism. That introduces a big speculative element. It's hard for a defensive investor focused on safety and value to consistently win with high-priced growth stocks.
Back to that margin of safety again. It's hard to find when you're paying a premium for future growth. This connects to doing your homework. Graham wasn't big on shortcuts like buy what you know, was he?
No, he was wary of that. Even though Peter Lynch made it famous, Graham would say just recognizing a brand name or seeing a busy store isn't enough.
It's superficial.
They can be. You need to actually look at the financials, understand the business model, the valuation. Familiarity isn't the same as analysis.
You need to dig deeper.
Mm-hmm.
And that understanding is vital when the market inevitably fluctuates. What did Graham think about the average person trying to time the market?
He was deeply skeptical. The idea of buy low, sell high sounds great, but predicting those turns consistently, he thought it was pretty much impossible for most people.
So just because the stock price falls, it doesn't automatically make it a good buy.
Correct. A low price isn't enough. You still need value. Does it have decent earnings relative to the price? Is the financial situation strong? Are earnings prospects reasonably stable? The fundamentals still have to be there.
Which brings us back to Mr. Market. How should we use his daily mood swings?
Remember, you don't have to trade with him. His crazy offers are just offers. The intelligent approach is to ignore him most of the time. Focus on your dividends, the company's progress. But when he gets really depressed, sharp market drops. That's your opportunity to buy intelligently. And when he gets wildly euphoric, big market run-ups, that might be an opportunity to sell wisely.
Use the extremes. Ignore the noise in between. Graham was also pretty dismissive of trying to pick hot stocks or sectors for the short term, right?
Very much so. He figured, look, all these professionals are trying to do the same thing, constantly analyzing, trading. It's incredibly competitive. For an individual investor to consistently outguess that crowd in the short term, highly unlikely. He called it self-neutralizing and self-defeating.
Focus on your own long-term game plan.
Yeah.
Interestingly, he also linked a company's long-term stock price to its management. How did he see that connection?
He argued that over the long haul, the average market price is a pretty fair reflection of management's competence. Good management should eventually lead to good results and a solid average price. Bad management. Eventually, the market price will reflect that too. It's a long-term scorecard.
A kind of market accountability. He used some great case studies to show market irrationality. Can you remind us of one or two?
Oh, Incastomai during the dot-com boom is a classic. Huge valuation, billions of dollars, despite never making a profit. Pure hype. Then the bubble burst, and the stock price just collapsed, like over 99%. Mr. Market went from ecstatic to suicidal.
Wow. And a Cisco versus Cisco comparison.
Yeah, that one's insightful. Cisco was the hot tech stock. Everyone loved it. Cisco was, food distribution. Boring, but stable and profitable.
Guess which one did better long term?
Cisco. Cisco got caught up in restructuring, big losses, stock tanked eventually. Cisco just kept chugging along, making money, and its stock did very well over time. Fundamentals eventually won out over glamour.
Great examples of ignoring hype. Now, given how hard it is to beat the market, Graham and Zweig strongly recommended a specific type of fund, didn't they?
Yes, low-cost index funds, especially a total stock market index fund.
Why?
Because they own basically everything, they guarantee you the market's return, minus incredibly low fees. Most actively managed funds, with their higher fees and trading costs, actually fail to beat the index over the long run.
So, mathematically, the index fund is likely to win.
Over time, yes. Zweig gives an example showing how much more money you'd likely have after 20 years in an index fund versus an average active fund, just because of the lower costs. Both Graham and Buffett agreed for most individuals, index funds are the smartest, simplest choice.
A powerful tool for the average learner. But if you do choose active funds, what should you look for in the management?
One key thing is, do the managers eat their own cooking? Do they have a lot of their own money invested in the fund alongside yours?
Skin in the game.
Exactly. It aligns their interests with yours. They're likely to be more careful, more long-term focused.
And when should you sell an active fund? Is short-term underperformance a reason? Zweig had a counterexample, right?
Yes, the Sequoia Fund.
Yeah.
It lagged the S&P 500 in many individual years, sometimes significantly, but over the very long term. Incredible returns. So his point was, don't panic and sell just because of a bad year or two. Understand the manager's philosophy. Do you still believe in their long-term approach?
Look beyond the short-term noise. Okay, many people seek advice. What did Graham think about investment advisors versus brokers?
He felt that true professional advisors, usually fee-based, tend to be more modest. They focus on solid companies, establish principles, avoid excessive risk or market timing. He was more wary of advice from brokers, suggesting you question if their incentives, like commissions, fully align with your best interests.
So for a defensive investor using an advisor, what should they tell them?
Be crystal clear about your preferences. Say, I want high-grade bonds and stocks of leading companies bought at reasonable prices. A good analyst should understand that and be able to work within those conservative guidelines.
Clear communication is key. What questions should you ask a potential advisor?
Dig into their process. What's their investment philosophy? Can they show evidence of long-term success? And crucially, ask them what they do when an investment performs poorly for a while. If they just say, sell it immediately, they might not be a good fit for a patient value investor.
Good questions. Let's shift to security analysis for the lay investor. How did Graham suggest individuals approach analyzing stocks and bonds?
He distinguished security analysis, evaluating specific investments, from broader financial analysis, portfolio stuff, economics. He thought non-professionals needed to understand the basics. It starts, he said, with reading and understanding a company's annual report. Focus on the core principles and attitude, not just complex formulas.
Understanding the story the numbers tell. What key areas did he highlight?
Financial strength and capital structure were big ones. A company with lots of cash and little debt, generally much safer than one loaded with debt, even if earnings are similar. Debt, leverage, can boost profits in good times, but hugely increases risk in bad times.
Makes sense. And what about growth rates and valuation?
He talked about using formulas to see what kind of future growth the market price was implying. He showed how back then the market expected way more growth from Xerox than from GM, but he cautioned that really high growth expectations are often unrealistic long term. Maybe 10% pre-tax growth is more sustainable. He also stressed R&D spending as important for future growth.
He was also critical of things like short-term earnings guidance from companies, wasn't he?
Yes, he disliked the focus on the next quarter's earnings and endless press releases about minor deals. He preferred companies that laid out clear long-term plans and were transparent. He also warned about accounting tricks like constantly having non-recurring charges or pushing pro forma earnings over actual net income.
Still relevant warnings today.
Yeah.
He mentioned special charges and tax benefits too.
Right. Understanding how big write-offs might impact future taxes could be complex, but important for seeing the true picture.
And pro forma earnings. Why the caution?
Originally, the idea was maybe to show a smoother growth trend by excluding one-off items, but Graham saw how easily it could be misused to paint a rosier picture than reality, hiding underlying problems.
He used case studies here too, right? Like Emery Air Freight?
Yeah, questioning if its high price, driven by past growth, was really justified by value. A warning against chasing past performance and paying too much.
What about stable sectors like utilities?
He noted their historical stability, but also pointed out that even relationships between sectors change. Utilities used to trade at lower PE ratios than industrials, but that shifted. So even defensive investors might need to adjust occasionally if a whole sector gets overvalued.
This leads to his two main approaches to security analysis.
Yeah.
Prediction versus protection.
Right. Prediction tries to forecast the future, which companies will do best long-term, and buys based on that, sometimes ignoring current price. Protection, which was Graham's strong preference, focuses on the present value. You buy with a margin of safety now to protect yourself if those future predictions turn out wrong.
Protection first. Okay, for the defensive investor wanting to pick stocks, what were his simplified criteria back then?
Well, one very simple idea was just buy all the stocks in the Dow Jones average, or better today, a total market index fund. If you insisted on picking, he said make the index fund maybe 90% and experiment with 10%.
But he did have specific quantitative rules too.
Yes, from the 70s. Adequate size, strong finances, like current assets double current liabilities, consistent earnings for 10 years, uninterrupted dividends for 20 years, and price criteria not more than 1.5 times book value and not more than 15 times average earnings over the last 3 years.
Applying all those would really narrow the list, wouldn't it?
Absolutely. It showed how hard it was even then to find stocks meeting all those safety checks. He also suggested simpler ideas like just buying important companies when they traded at low price-to-earnings multiples, or buying a diversified group of stocks selling below their net current asset value, working capital, which he said had worked well historically.
What about convertible securities, bonds, or preferred stocks that can convert into common stock?
Generally, he didn't like them for conservative investors. He found they often performed poorly, especially those issued in bull markets. They didn't offer the downside protection you'd expect from a senior security, and they could dilute common shareholders' earnings.
He also shared some unsatisfactory situations as warnings, like AAA Enterprises.
A classic hype story. Small franchising company, heavily promoted, then quickly went bankrupt. A cautionary tale.
And Penn Central.
That was a shocker. A huge, established railroad going bankrupt. Showed that even size doesn't guarantee safety. He also detailed NVF Corp. Sharon Steel, a complex merger with tricky accounting that made the stock look cheap based on potentially flawed earnings.
Underscores the need for diligence.
Yeah.
Zweig added more recent accounting examples, too.
Yes, like Lucent looked dominant but had weaknesses, and Tyco rapid growth via acquisitions but plagued by huge non-recurring charges that made you question the real profitability.
Graham also liked comparing similar companies with very different market valuations.
Right, like National General versus National Presto. Presto was smaller but more profitable and financially sound, yet the market valued the riskier conglomerate, National General, much higher. Or Whiting Corp versus Wilcox and Gibbs, similar irrational disparities. It showed the market doesn't always make sense short term.
Which circles back to the investor versus trader mindset. Graham's preference was clear.
Always the investor. Focus on underlying value, not trying to guess short-term price moves.
And he warned about hot stocks and IPOs. The Cisco dialogue really captured that.
Yes, the emotional pull of the hot story versus the boring fundamentals. Cisco won long-term. He cautioned on IPOs, too. For every Microsoft, there are tons of failures. We tend to remember the winners and forget the losers, and often the big initial IPO gains go to institutions anyway.
Don't chase the hype. He briefly touched on improving investor management relations.
Yeah, encouraging shareholders to actually vote, attend meetings. He even floated the idea of independent directors issuing their own report to shareholders, separate from management's.
Interesting idea. And the potential conflict with stock buybacks versus dividends.
He pointed out that if executives have lots of stock options, they might prefer buybacks, which can boost the stock price and their option value over dividends, even if dividends might be better for long-term shareholders overall. Something to be aware of.
Okay, let's revisit margin of safety one more time. It's not just wishful thinking.
No, absolutely not. It has to be based on demonstrable figures, logic, experience. It's about minimizing the chance of a major loss, not just hoping for the best.
And diversification and a long-term view are crucial complements to that.
Definitely. He used JDS Uniphase, another tech bubble casualty, with a huge valuation and big losses to show the danger of putting all your eggs in one basket. Permanent diversification is key insurance. And thinking long-term, especially with index funds, helps you ride out the volatility.
Graham also touched on psychology, how our own minds can trip us up.
Yes, our brains look for patterns, even in random market noise, which leads to bad timing. And we overreact to big point drops without considering the percentage change, leading to panic selling.
Knowing your biases is the first step. He briefly mentioned taxes, too.
Just the basics. Interest and dividends are usually taxable, except things like muni bonds, differences between short-term and long-term capital gains, and the ability to use losses to offset gains or some income. Standard stuff, but important.
And he often pointed to the super investors of Graham and Doddsville.
Right. That was Buffett's term for investors who strictly followed Graham's value principles and consistently beat the market over decades. Real-world proof that the approach worked.
Buffett also used that bridge analogy for margin of safety.
Yes. Build the bridge to carry 30,000 pounds if you only expect 10,000-pound trucks. That extra capacity is your margin of safety. Don't try to buy an investment for $9.9 million just because you think it's worth $10 million. Leave a much bigger cushion.
So why hasn't everyone adopted value investing if it works so well? Zweig had thoughts on that.
He kind of mused on a perverse human characteristic to make easy things difficult, and noted that academia had largely moved away from focusing on value. But he was confident that gaps between price and value would always exist, creating opportunities for those who stick to Graham and Dodd's principles.
So the core ideas remain powerful, even decades later.
Absolutely. The landscape changes, the tools change, but the fundamental principles of intelligent investing, rationality, patience, margin of safety, they endure.
Okay, so to wrap up this deep dive, the key takeaways really are about that rational, value-focused, long-term approach. It's about the business fundamentals, that margin of safety.
And being incredibly wary of speculation, market hype, and your own emotional reactions.
We really hope you'll think about how these principles apply to your own situation, and maybe even go back to the intelligent investor itself for a richer understanding. It truly is timeless.
It really is.
And our final thought for you today, take a moment and honestly ask yourself, which of your current investment beliefs might be driven more by emotion or speculation than by solid analysis? And maybe think about one concrete step, just one, you could take this week to start moving towards a more intelligent, Graham-style approach for your financial future. Thanks for joining us on The Deep Dive.